Have you ever stared at a crypto chart and just felt completely lost? Like you're trying to read some ancient alien language? Well, today we're going to translate it for you. We are going to cut right through all that noise and show you how to find clear, simple signals in what looks like total chaos.
You know the feeling, right? We've all been there. You hear about some coin that just skyrocketed, and that little voice in your head goes, "Ah, you missed it. Again." That sinking feeling, it actually has a name. And in the crypto world, it is probably one of the most powerful and most dangerous emotions you can ever face as a trader. And that name is FOMO, fear of missing out. It's that gut punch feeling that makes you want to jump on a speeding train without even checking where it's going. It's the force that pushes people to buy at the very top when everyone's screaming to the moon, and then panic sell at the bottom when fear takes over. It is literally the exact opposite of a winning strategy. And look, the damage isn't just about losing money. This slide shows the real human cost of trading on emotion. It can seriously mess with your head, strain your relationships, and just tank your overall quality of life. And that is exactly why mastering your own psychology is the first, and I mean the most important step. Okay, so here's our game plan for today. We're going to start by cackling that fear head on. Then we'll learn the basic language of the charts, pick up some essential vocab, learn how to spot patterns, and then finally put it all together into a real strategy that crushes that impulse to FOMO. All right, first things first, let's talk about your brain. Before you even think about looking at a chart or placing a trade, you absolutely need a mental framework. A shield, really, to protect yourself from FOMO. And here's how you build that shield. Think of this as your pre-trade checklist. Do your own homework, have a plan before you start, and this one's huge. Accept that you are not going to catch every single winning trade. It's impossible. Understanding that markets move in cycles is so key because it means there will always be another opportunity right around the corner. Okay, is your mindset in check? Good. Now it's time to actually learn the language of the market. We're going to start with the most basic building block of any trading chart, the candlestick. Now, this one simple shape packs in a ton of information. Seriously, each one of these candles tells you the complete story of a battle between buyers and sellers over a set period of time. It shows you where the price opened, where it closed, the highest it went, and the lowest it went. That thick part is called the body, and those thin little lines are the wicks. And here's the absolute core idea. It's super simple. If a candle's green, it means the price closed higher than where it started. Traders call that bullish, like a bull thrusting its horns up. If it's red, the price closed lower than where it started. That's bearish, like a bear swiping its paws down. That's it. It's the market's entire story, just told in green and red.
All right, so now that we know the letters of this language, the candlesticks, let's learn a few key words. This is the basic vocabulary you're going to need before you can start reading the sentences that these charts are trying to tell you.
These four terms right here, they're the foundation of any trading plan. Your entry is simply where you get in. Your target is your goal, where you're going to take your profits. And your stop loss, that's your escape hatch. It's the price where you say, nope, I was wrong, and you get out to protect your money. And a retest is just when the price comes back to visit an important line on the chart. If you know these four, you are way ahead of the game. Okay, this brings us to the real heart of it all. How do you look at a chart that just looks like a crazy, chaotic mess and find simple, recognizable patterns? Well, this is where we learn to turn all that market noise into actual potential trading signals. So, first up, we've got the double bottom. See that clear W shape? The price drops, it finds a floor, a support level, it bounces, and then it comes back down to test that same floor a second time. When it holds that second time, it's a pretty good sign that the sellers are getting tired and the buyers might be ready to take control. And on the flip side, you have the triple top. This looks like a big letter M. Here, the price pushes up to a ceiling, a resistance level it just can't seem to break, and it fails not once, not twice, but 3 times. This is a really strong hint that the buyers are running out of gas and the price could be about to turn around and head down. Now, okay, I know what you're thinking. Things can get a little more complex with patterns like these BAT patterns. They're called harmonic patterns, and they use some specific math to form, but don't get too hung up on that. The core idea is exactly the same. These very specific shapes can help us predict where the price might be getting ready to make a turn. And hey, not all patterns are these sharp, jagged shapes. Sometimes you'll see these really gradual curves. A rounding bottom, which looks like a saucer, shows the slow, steady shift from selling to buying. A rounding top is, well, the exact opposite. a slow turn can be just as powerful as a sharp one. This diamond pattern can be a little tricky to spot in real time, but man, it's a powerful one. It shows the market has kind of taken a breath, with buyers and sellers locked in this tight battle. It's like a spring coiling up, tighter and tighter, right before a huge explosive move.
So what happens when the price swings just get bigger and bigger and bigger? Well, you get an expanding triangle. This megaphone shape shows you that volatility is increasing. The market is getting wilder, there's more uncertainty, and eventually all that energy has to break out in one direction or the other.
So we've looked at all these patterns, but here is the most crucial takeaway. These are not magic crystal balls. I gotta repeat that. They're just tools. They're tools you can use to build a disciplined plan that helps keep your emotions on the sidelines.
And this is just a perfect real-world example of how it all works. Here's a rising wedge pattern on an actual Bitcoin chart. Now, the emotional trader sees the price going up and thinks, I gotta get in. Pure FOMO. But the strategic trader, they see the wedge forming, they know it's often a bearish pattern, and they wait patiently for the pattern to play out before they make a move. No impulse, just strategy. This quote from our source material just nails it. It says it all. The patterns give you a clue, a potential setup, but the real strategy is in the waiting. Waiting for the price to prove your idea right, to break that key level or neckline. That's what separates disciplined trading from pure gambling. Patience is the secret sauce. And really, that's the final thought I want to leave you with. Learning to spot a W or an M on a chart, honestly, anyone can learn to do that. But the real challenge, the thing that separates the winners from the losers in this game, is mastering your own mind. It's having the discipline to stick to your plan, even when that powerful feeling of FOMO is screaming in your ear to do the exact opposite. Master that, and you've truly mastered the charts.